Hello, it's ChewDog Charts, and today I'm going to dedicate this video to my #1 subscriber. Figuratively, literally, and absolutely my #1 subscriber. We're going to talk about debt and confidence. So let's take a look. If you've followed me long enough, you know that what I try to do is first present some information and then go to the charts to see if there's any impact or to see if there's any possibility of forecasting a result, a stock result or an index, something like that. Just to take a look and internalize the information and see if we can take that information and gain an edge in our investing. What we have here is a chart showing the S&P, the consumer confidence, and then the saving rate. Consumer confidence and saving rate of individuals going back to the late 1960s up to the current time frame. This is created by Elliott Wave International as of November 2017. And what we see here, and we've seen this before, is that we seem to go through these cycles. And particularly with regard to my stocks, when I look at the stocks, I like to look at the cycles because a lot of times a particular stock or an index will have a very predictable cycle. And that's where you can gain an advantage in your investing. And here, even consumer confidence, even the savings rate, go in cycles. It seems like when we have good times, and those good times have gone for a sufficiently long period of time, people forget that there is any other way. They don't remember that stocks can go down. And they start behaving like investors that are bulletproof. So when they think that the market is going to continue to go up and up and up, then they stop saving, simply because they feel that their job and their stocks are going to do well, and so there's no need to save. But then the inevitable bust comes, as it has before. So when you look at this chart here, you'll notice, if you can see my cursor, this period here was the confidence reached a high of about 140, where the savings rate was down here. And this coincided with the peak of the market in the 2000 time frame, the year 2000, going here to the second peak in consumer confidence, probably in the 110, 120 range, and then the savings rate down here below 4%. This coincided with the 2008-2009 crisis. And here we are today. Consumer confidence is up and the savings rate is back down. And this is a pretty wide disparity between the two. So I look at this and I think back in the past and what has happened, and I use this information to prepare for what may happen in the future. There's no absolute. It's just a probability. And to me, the probabilities continue to increase that we're coming to maybe not a crash, but at least perhaps some sort of consolidation or a rest in the market, perhaps a bear market. I don't know, but I just want to make sure that the people that follow me are prepared. So let's go take a look at some other charts. Now, I've shown this chart before, and this is the most recent information. The chart itself was created in October. The data from the Fed is accurate through September 2017, and November's chart won't be created until the end of this month when the Fed updates the most recent information, which will then be October. But we've looked at this chart before, and I like to look at this chart because it just simply shows the level of margin debt in comparison to the S&P 500, and there seems to be a fairly good correlation. And you can see going back to prior to the peak in 2000 that we had a peak in the margin debt at this point here. This is 400 billion. Dollars of margin debt, and then of course superimposed is the S&P 500 with the peak occurring maybe a couple of months after the peak in the margin debt. Here in 2000, the 2007-2008 timeframe, a peak again in margin debt with the peak in the S&P 500 following again by another month or two. Now, the current information shows that we continue to climb both on the margin debt and on the S&P 500, with the margin debt now here probably in the mid $550 billion. And of course, we're reaching record highs in the S&P and the other indices. So one thing that we need to pay attention to is the absolute level of the margin debt, and if that starts to contract, that may portend a peak in the various indices. We see that a contraction here in say mid-late 2015 occurred, and we had some consolidation in the S&P 500, but we didn't have a bear market or anything like that. But we need to keep an eye out on the margin debt because it could portend at least a consolidation at minimum in the stock market. Let's go ahead and take a look at another representation of the same information. This chart essentially shows the margin debt and the S&P 500 using the real growth since 1995, and it's just a different representation of the information. The data is good through September of 2017, and we show the actual real growth both on the margin debt and the S&P 500. We see that the real growth in debt continues to climb, though we have a cluster of data here at this point. The last several months are starting to cluster here. So I'm paying attention to that. In previous periods, we had some extended growth in the margin debt. And then a peak, and then the subsequent decline. This cluster here, I'm not sure what that necessarily means. I'm sensing perhaps that there is a bit of exhaustion in the debt growth. So we'll watch this. And the reason I say that will be borne out in another chart we'll take a look at a little bit later here. But now let's go take a third look at a different representation of the margin debt. This chart here shows the NSYE, investor credit, and the market, the overall market through the S&P 500. The credit balance, as stated here, is calculated as the sum of free credit cash accounts and credit balances in margin accounts minus margin debt. The negative credit balance is shown in the red. Here we are at the current record levels of credit. The green is the positive credit balance shown here, and then of course the blue represents the S&P 500 with the monthly close toward the record levels here. Now, I keep track of the credit balance and the margin credit information simply because the stock markets are fueled by cash, of course, and if we see a change in that level, then that could portend a change in the overall market. So there are two ways to look at this. This is one way, which is simply the overall levels of the credit and margin, and we're at record levels. So that in itself to me is simply a warning sign. However, we've been reaching new levels of credit for quite a long time here. So it's nothing unusual, but at some point in time, that rubber band is going to stretch and stretch, and then it's going to snap. And I'm looking for that snap. Don't see it here yet, but this is something that we want to keep in mind so that we can prepare for a correction, a bear market, or an overall crash. So let's take a look at this information from another perspective. This is another way to take a look at the margin debt versus the S&P 500. If you recall from an earlier chart, I had showed you that the margin debt, the current margin debt, seems to be clustering in an area, that there wasn't a large or significant acceleration in the rate like we've seen here before in the 2000 time frame, and then also here the acceleration in, say, 2007, 2008. The current margin debt seemed to be clustering at the top, and this is how it is borne out in an acceleration deceleration type chart. But this formation raises as much of a red flag as do these, where there is significant acceleration. This shows here that the clustering is indicating a possible deceleration, and perhaps we're heading down to zero. And if we go below zero, that's where a problem can occur. The deceleration in the margin debt, again, is a sign that perhaps we're going to have a deceleration in the stock market. So it's not necessarily saying that we're going to have a crash, but it's just raising the probabilities of a correction, potential bear market, and ultimately perhaps a stock market crash. But I'll make this one promise to you. We will have an idea before most anybody else. We'll keep an eye on this information here. So I appreciate my #1 subscriber. I'd like to have more subscribers. So please write your comments, perhaps click the like, and subscribe. For now, that's ChewDog Charts. Thank you.